A lot of people believe that when the energy sector takes a header, the rest of the market follows suit. Well, Ben Cook from the Hennessy Energy Transition Fund and the Hennessy Midstream Fund, he doesn't think you have to worry about that kind of a fall this year.
If you look over the near term, we anticipate that crude oil prices will remain subdued on the back of adequate supplies. As you may know, OPEC Plus and their quota alliance will be returning a little over 2 million barrels per day by the end of September of this year. That should provide for oil price stability, we think, through the end of the year.
He's batting cleanup and doing the big interview today, but we start with Todd Rosenbluth, head of research at VettaFi, making the rare move of bringing back a fund that was ETF of the week. In fact, it's the most rapid bring back in the history of ETF of the week. Plus, if you're planning summer vacation and you don't want to be standing on lines in theme parks, you need to hear my interview with Melissa Stevenson, who did an analysis showing which theme parks are worth the waits you have for the lines you're going to stand in. Plus, I'll answer a question from 2 listeners, one of them my daughter, about what to make of the so-called Trump accounts that made my soon-to-be-born grandson richer before he even establishes his birthday.
Bring it on, baby.
Well, yeah, at this point, I think my daughter would be happy if you could bring on the baby, who is not actually due for a little bit over another month. But bring on the money for the baby. That's what's going on as a provision of the budget bill that passed last Friday. So, yeah. And it's a thing that I'll give you a very long, very detailed answer to questions, one of which from a listener, the other from my daughter, basically saying, what should I do with this? What should I make of this? I will make the point here, but I will make it again later when I talk about it. People are already gravitating to call these things Trump accounts. Please don't. It's not that I don't want him to get credit, because this is a good thing. It's that Obamacare is a good thing, and yet there have been people who have been reluctant to take it up because they're not on that side of the political aisle. And ironically, they don't seem to recognize that it's the Affordable Care Act. Like, they're all in favor of affordable care, just not in favor of something by Obama. This is a good thing. Like, no matter what you want to say about these accounts, and I will tell you all about them later, it's a good thing. It's $1,000 for babies born this year through 2028. And it is retroactive to January the 1st. So if you know anybody who's had a kid, the kid's getting $1,000. And it's designed to encourage long-term savings and investing. Great stuff. But I don't want anybody to miss out on it or potentially not want to participate because people are describing it using the current president's name. Like, let's not do that. And by the way, I'm not going to get into stuff on the bill, what it did and whether this was worthy and other things weren't. I'm not going into any of that. Like, we say we try not to be political on the show. Well, you've got to discuss some of this stuff. You have no choice but to do it. I would be delinquent in my duty of trying to keep you up to date on things that are happening in the personal finance world if I didn't do it. But in all things political, much more so in the past than now, where there's not much compromise. But this was bipartisan in terms of the support for it. So it could have been in, regardless of who was putting forward a budget bill. There are things that you might like and things that you might dislike. And somebody gets to choose, yes, keep this in or get this out, use this to balance something, or not balance it and keep the stuff in there. But you and I don't get that choice. We just get to react to it. So again, I'm anticipating some of the notes I will get from you, and I love getting them. Chuck at moneylifeshow.com is how you reach me. And I will simply say it is possible to like a provision of a law and dislike the rest of the law, or to love a law but dislike a provision in it. The S&P 500 couldn't quite get to new records yesterday. It finished at its second highest level. It's expected to fall today because we've got a couple of earnings reports, including NVIDIA, are coming that might be a problem. But by the way, Bitcoin hit a record high. It got to 112,000, though it didn't hold it for very long, but still could get back to it. It'll be interesting to see whether something up here winds up setting a new level of resistance and whether that rally cannot continue. But speaking of Bitcoin, well, it's a Bitcoin-related fund that Todd Rosenbluth is bringing back. I'll let him explain it when we talk about the ETF of the week, but it's really interesting. It's a fund that I was a little surprised when he picked it not that long ago. I was a little surprised when he brought it back. So I think it makes for good chatter. And Melissa Stevenson is here. Like, who doesn't love a good theme park? Well, this may tell you which theme parks are good. There's some interesting numbers in it. It's an interesting analysis. I don't know that you could necessarily say, oh, I'll just go to the theme parks that are considered good on this list because they don't necessarily have the shortest wait times, but they have few complaints to go along with whatever their wait times are. And that's the problem, is that they're looking as they do this analysis for the level of complaints about waiting. And there's more that goes into it, and she'll explain it. But I did find it interesting. And I was pretty pleased that, like, of the top 10, I've been to like 4 of them, yet I haven't been to any of the bottom 10. So that's our lineup. Let me know what you think. It's a little bit of a different show. Chuck@moneylifeshow.com is how you reach me, and I'd love to hear from you. But right now, let's let you hear from our guests. Todd Rosenbluth kicks us off with the ETF of the week when we come back right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
One fund on point for today, the expert to talk about it. Welcome to the ETF of the week. Yes, this is the ETF of the week, where we examine trending, new, newsworthy, unique, and intriguing exchange-traded funds with Todd Rosenbluth. He's the head of research at VettaFi, and that means he's behind a lot of their tools, which you can find at VettaFi.com if you're looking to make yourself a better, smarter, savvier investor in exchange-traded funds. Todd Rosenbluth, it's great to chat with you again.
Great to be back, Chuck.
Your ETF of the week is
the CoinShares Valkyrie Bitcoin Mining ETF, WGMI.
Wow, WGMI, CoinShares Bitcoin Miners. This rolls off my tongue because it rolled off my tongue at the beginning of March. We very seldom revisit funds, but we've never in the history of ETF of the week revisited a fund this quickly. So why are we back on this fund now?
So 78% is my number for you. 78% is how much WGMI went up in the second quarter. We at VettaFi wrote an article about it a week ago. Our team did, and it caught my eye. I was like, I remember that fund. We talked about it in March. I remember you sharing constructive feedback on it was on its way down, and were we too early? And relative strength, I guess we call that relative weakness, up 78%. I figured let's come back to it. This is a great ETF for people who want to do a risk-on approach, equity approach to getting exposure to cryptocurrency. We've talked about individual cryptocurrency ETFs, spot Bitcoin, spot Ethereum. I think we might have talked about as well in our conversations. This is an equity exposure. So it's going to fit more easily into a portfolio for many folks, and it's worked. And so, yes, this is the rare time I'm coming back. Maybe you have applause and you can put in there that basically shows this one worked. So when it works, I'm going to come back and take a quick bow.
And you could do that more often if you wanted to. Plenty of your picks do well, but there's a lot to still unpack, because when we first discussed this, one of the big things was that first, we got spot Bitcoin ETFs, and you and I talked about them, and then it expanded to some of the other crypto. But this is a miners ETF. That's why it's the equity ETF. And just as there is a difference between do you own gold or do you own gold miners, and how do miners versus the metal itself perform, well, that's what seems to be showing up here with crypto, that there is a difference, which we didn't know for sure that there would be, between owning the asset itself or owning the miners. And in this case, I'll point out that, like, if you looked at the Bitwise Bitcoin ETF, you weren't hurting during that second quarter. It was up 35, 40%, something along those lines. But again, miners did much better. So does this advocate for, if you're going to be a crypto investor, own both sides, own the crypto, but also own the miners?
So you certainly can fit both of these into a portfolio, both being an ETF like WGMI, or CoinShares has its own spot Bitcoin ETF. The ticker is BRRR. Just if we wanted to use two of the CoinShares products side by side. So we did see stronger performance, much stronger performance in the last 3 months for WGMI. But year to date, it's actually underperforming. So it fell further and it rose further, or rose higher. So that's a good thing for people who are comfortable with that risk-on approach. It's certainly differentiated between having exposure to spot Bitcoin. You can fit both of these ETFs within a portfolio, but yet you are exposed to the direction of Bitcoin and Bitcoin going up in value. And you'd have to be a believer that Bitcoin could be additive to your broader portfolio, much like you said with gold and gold mining. So you'd have to believe that there was going to be greater demand for gold for you to own gold directly and own the supplier of that gold. This is a newer age version with Bitcoin exposure through these two CoinShares, or the CoinShares ETF that we're primarily focusing on, and then of course the spot Bitcoin ETF that they're not alone in offering.
What we saw with the advent of Bitcoin funds was this huge rush into them, both from the industry standpoint, lots of funds created, and then the investor standpoint, demand had been pent up. Give me my chance to get in there. We have seen less activity in terms of people creating mining funds. Some of the activity seems to have slowed at least a little bit in the space. Are we getting to where the Bitcoin space very quickly has kind of gotten fully developed, and what we're really seeing next is going to be more of the Ethernet and other odd cryptos and other things that are beyond the mainstream ones? Or is there still a lot of room left to go, which would, by the way, also be another reason to own the miners?
So I think there's a supply of ETFs part of that conversation, and a demand for Bitcoin, and thus what will ultimately drive the returns. So we're not seeing a slowdown in the number of crypto related ETFs that have come on market. And we now, as an industry, are moving on to Solana as another third leg of that, with Bitcoin and Ethereum. There's perhaps other ways to get exposure to cryptocurrency that might find its way into the ETF wrapper. But we still are at really early days for crypto ETF adoption and or for Bitcoin within a broader portfolio adoption. It's still, for many advisors, is not part of the portfolio for their end investors, or if it is, it's a low single-digit percentage, as many people either are getting more comfortable in what the reward it can add to the portfolio, the risk that you take on. So I still think there's room for adoption. What appeals to me about this CoinShares equity ETF is the equity part of it, because for many people, it's still not possible, or it's harder for them to get their arms around to add an alternative like Bitcoin. But you could add WGMI, and I'm sure some people have done so. The ETF has started to grow in size as part of your risk-on equity exposure. But what you get is quite different. We've talked about the NASDAQ 100, the triple Qs beforehand, or even the core S&P 500 strategies. You're going to find differentiated stocks in here. There's little overlap, if at all, to what you'd have in your core large cap equity exposure. So that's additive to the portfolio. It means you should think of it within your equity slice of a portfolio and benefit from the rewards that can happen.
At that same point, how much do you put on the airbags and try to make sure you've got some protection? I mean, how much of a portfolio would you let this fund be? Let's point out, it's not just that it's capable of doing 78% in a quarter. This fund was up 300% in its first full calendar year. So you've got something that can run, but I would assume you'd want to both cull your winnings when you get them and be careful. So is there a mental space for you that this should occupy in people's portfolios?
So I think of this not as a Bitcoin ETF, but as a thematic equity ETF. I think we've talked about that. We find that many advisors and investors have roughly 5 to 7% of their portfolio tied to thematic equity strategies. That can be Bitcoin mining and tied to crypto equities. That would include artificial intelligence equity ETFs, or robotics, healthcare technology. So this could fall into that slice of the narrower risk on equity part of your portfolio. And yes, you noted this fund had a tremendous run a couple of years ago. There's some time periods, obviously, when it falls down in value. This is a risk on. And as a result, when the market shifts or when the market sells off, this is an ETF that will face some volatility on the downside also. So you want to have this fit in within a broader diversified portfolio, not be the core of your portfolio.
And last question here, Todd, because you are taking a bit of a victory lap and we are talking about this fund after a 78% plus quarter. You don't normally make market calls, and I'm not suggesting that it is one, but presumably if you didn't think this had some more room to run, you wouldn't be ringing the bell on it again, would you?
Right. So I think in the second half, if we are in more of a risk-on environment, and a lot of that depends upon the macro economy and what's going on with global relations, the market is going to remain volatile. This is an ETF for people who are willing to lean in to that volatility, and there's room. Again, I'm pleasantly surprised that you didn't share with me the charts, but I believe the technical analysis is supportive of this ETF going forward. It's rare that I'm bringing that to the table instead of you doing so. Usually you point it out when it's not necessarily with the relative strength you did last time. I think the charts are favorable for this. Let's hope they're right.
It's WGMI, the CoinShares Bitcoin Miners ETF, the ETF of the week, again, from Todd Rosenbluth. Todd, great stuff. And yeah, good pick. Good to talk about it some more. Thanks for joining me.
Thanks a lot, Chuck.
Todd Rosenbluth is head of research at VettaFi. Go to VettaFi.com for more information on all that they do and check out what they've got on your favorite ETFs. And of course, Todd just gets us started every Thursday here on Money Life. So we just got started. We've got a lot more to go, including Ben Cook, manager of the Hennessy Energy Transition Fund, and Melissa Stevenson talking about amusement parks. But up next, I'll be talking about the Trump accounts for babies, like my soon-to-be grandchild.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Anybody have any questions?
Any questions?
Oh, you can ask questions.
I should have all the answers for you in about 10 minutes.
It actually may take me a little bit longer today because this is a complex question and I'm answering it for somebody who really wants to know and needs to know. And you'll know more about that in a second because I don't normally know the questions that I'm going to get. And I would love to get questions from you. You just have to send them to me, chuck@moneylifeshow.com.
I'm sorry, but all questions must be submitted in writing.
But I knew that this one was coming. And I didn't even play all of our sounders about questions because I knew who was going to ask me about it first. Now, I will say that my daughter Whitney only beat an audience member by a few minutes. But as you know, my youngest is giving birth to a son in August, and that baby, for all intents and purposes, got $1,000 richer when the president signed the sweeping budget bill into law last Friday. And what Whitney and Peter in Wesley Chapel, North Carolina, both wanted to know was what I thought of the so-called Trump accounts that were swept into being as part of the massive budget bill. So if you haven't heard about this, buckle up, because most of the media focus and the public's attention was on tax cuts or Medicaid cuts or reductions in the food stamps program. One thing a lot of people missed out on was the idea of a new tax-advantaged investment account pre-funded with $1,000 for every child born from the beginning of 2025 through the end of 2028. By the way, it's worth noting that children born before 2025 are eligible for these IRA-style accounts, but they're not eligible for the $1,000 of seed money. So Whitney having a baby in August, that baby, $1,000. That's what it's getting out of that bill. It's not a new idea. And I will point out, it had bipartisan support. You can argue about what parts of the bill made it or shouldn't have made it and who voted for it, but this had bipartisan support. It also had my support. Since I've been saying for years that I felt a variation of this would be a huge help to Americans and the economy and would help bolster the future of the Social Security safety net. Backers say that the accounts are a way to get all kids into saving and investing early in life, helping them save for goals like college or a home. And if I were king of the world, I would have done things a little bit differently than what we are getting here. But let me make it clear, I am a fan of the idea. Let me also make it clear that I do not want these to be called Trump accounts. And that's not just because of any feelings for the president, but because I think it's bad policy to name any public policy for a politician. I have met people who say they hate Obamacare, but they have no problem with the Affordable Care Act. And those are the same thing. I do not want parents somehow refusing or turning away from this opportunity because they dislike the current president. And that, by the way, includes my daughter, who most assuredly is not a supporter of the president. Before I dive in to these accounts, I want you to know that I first looked at provisions of the rules before the bill passed. And I know there were some changes to the legislation before it passed. I think I have everything correct in my descriptions here, but it is possible I crossed my wires somewhere. And I just warn you that whether you hear about this and take it from me or any other source of financial information, trust but verify, even with a source like me. So with all that out of the way, let's get down to brass tacks on how these accounts work. What was approved and signed into law makes these accounts available to any child born between January 1st, 2025 and December 31, 2028, who is a U.S. citizen and whose parents have Social Security numbers, or if the parents are unmarried, the parent who is filing for the account has to have a Social Security number. Parents can open an account for a child at any bank or qualifying institution. If a parent does not voluntarily create an account, the government will create one when the parent files a tax return. When the account is opened, the government will deposit $1,000 in seed money. In any given year, a maximum of $5,000 can be contributed to these accounts. So this means that parents and grandparents can add to the account. More on this in a moment because it's a key component of my advice to Whitney and therefore the world. And the parent's employer, by the way, can also put a maximum of $2,500 into these accounts annually. That'd be a great fringe benefit. And yeah, the family could do more, the employer could do more. That's all part of it. But let's finish with the workings of the account. The money in these accounts grows tax-free until it's withdrawn, and it must be invested in a broad stock index. So you can't just set it aside in a savings account. When the child turns 18, they can spend the money in one of four ways: higher education expenses, other qualifying post-secondary credentialing courses, etc., starting a small business or small farm expenses, or purchasing a first home. Now, at that point, the account effectively turns into a traditional IRA, though with a few different stipulations because the child will have full access to the money when they turn 31. These are tax-advantaged accounts, so it's important to know the advantages. The money grows with no taxes paid until distributions are made. When you withdraw money, you'll be charged the capital gains rate on any gains you use to pay for qualified expenses. That's higher education, secondary education, a first home, small business, or farm expenses. But if you spend it on non-qualified expenses, you're taxed at income rates, wage income rates. In the end, the financial advisors that I talked with agreed that aside from the free seed money, the benefits these accounts offer are kind of skimpy compared to other tax-shielded savings like 529 accounts that parents use to put away money for college and IRAs for retirement. A 529 account and a Roth IRA for retirement both allow investors to withdraw their money entirely tax-free, and that's a better deal. Though at some point, I'll explain my plan for opening an IRA for my grandson, which takes a bit of finagling and might not be possible without a bit of a wink and a nod to some IRS rules. You will hear more about that from me when the time comes. But you still are looking at the traditional stuff and the new account. And the new account, and let's call it a birthright account, though maybe somebody will come up with something better that doesn't use the president's name. But these birthright accounts could theoretically be useful for families who are already comfortable with their retirement savings and whose children don't plan to pursue college, since the money can be used for other purposes like home buying without a penalty. But even then, there are a lot of situations and things that could come up. And I don't know how you know that a child born today is not going to pursue a college education. So, for example, let's say the child ends up spending the money on anything other than education, or a business, or a house. If that happens, they get hit with that higher ordinary income tax rate. Well, then they and their family would have been better off just investing in a normal brokerage account. Just put the money in the stocks and pay the taxes without the tax deferral. You'd be okay because you're not really getting hit with it all at once, etc. By the way, I plan to do just that. I plan to build a stock portfolio for the baby using stock slices. I'm already doing that for my grandnephews. So normal brokerage accounts still valuable for a child. The concept of providing every child with a small pre-funded investment account, it is not new, even in Washington. In 2010, there were two economists who argued for an idea that they called baby bonds, which would have involved a lot more money, like $20,000, which they argued could help close the racial wealth gap. Republicans, a couple of hedge fund managers who got the ear of Ted Cruz, of all people, Ted Cruz being credited for originating this proposal, which, by the way, he called Invest in America accounts, argued for something more moderate as a way to get kids and families interested in investing and in capitalism generally. And one good thing about these accounts is that for low-income earners, this set money aside and let it grow is not the way they normally get assistance. The idea that they'll be forced to invest for the long term, to watch it grow and see the impact and have that inspire them, that could be very good for people who need it, which, by the way, is why the Democrats got behind the proposal. And by the way, then it somehow made its way into the bill. And because the price tag was estimated at, and I'm using air quotes here, even though you can't see me, the price tag was estimated at only $17.5 billion, and the air quotes, it got included and then left in place as the bill wound its way through Congress. So no matter how you feel about the bill, if you are having kids or grandkids, you get some benefits here. How much money this turns out to be, truthfully, depends actually on the market. I've seen estimates that pegged it at anywhere from $7,000 to $10,000, but truthfully, that seems high to me. Why? Well, let's do some simple math. The rule of 72 says you divide the number 72 by the rate of return you expect to get, and that will tell you how long it takes for you to double your money. And everyone wants to assume that you'll get a 10% annualized return on the market, which would mean doubling every 7.2 years. But let's be just a little conservative and say the market average is 9%. Well, then you double your money every 8 years. If it's 8%, it's every 9 years. And Lord knows the market could be negative or close to negative, etc. But let's just go with that 9%. You double every 8 years. That means your $1,000 birth deposit becomes $2,000 in 8 years, grows to $4,000 by the time your baby is 16, and it'll be another quarter of the way to the next double. So that puts it in the ballpark of $5,000 when the kid hits 18. I do like that the accounts are automatic and universal, which is important when you're trying to come up with an equitable program. And I'll point out, there was a group in Oklahoma that started putting students into what they called child development accounts like 18 or 20 years ago. They did this with 2,700 students there, and the research is still ongoing. But the study has found that the accounts had wide-ranging social benefits beyond just building assets, right? Parents of the children with accounts, they had high expectations about their children's education. They had less intense maternal depressive symptoms. They had reduced punitive parenting practices. In other words, they were better parents and less stressed. And children had an improved early social emotional development phase and greater college preparation than children in the control group who didn't get the money. I do worry that the small accounts will not be appealing to the big financial institutions, and that whoever becomes the financial intermediary could impose fees that really hurt. So I'll be curious to see if the government anoints one or two firms to do this work at a reasonable cost. I also have to say that one provision of the bill worries me. As this thing gets started, parents need to claim their $1,000 through a bank, and lower-income families are more likely to be unbanked. That doesn't affect my daughter. I would hope it doesn't affect anybody in your family, but it is a real thing. All of this ultimately brings me back to the basic question asked by Whitney and by Peter in Wesley Chapel, which amounted to, what do I think of the Trump accounts? Again, their words on the calling it the Trump accounts, not mine. Okay, for starters, take the $1,000. If we call it a birthright account, it's the birthright of your child. It's money that you and your child would not have otherwise. So go get it. And for anyone who thinks their family will grow after 2028, hope the program works and that it gets extended. But as for additional contributions, which is part of what Whitney was definitely pushing to figure out, well, I wouldn't do that just yet. Not unless it was my employer who was contributing. For starters, you've got to see how things work out. You got to look at the fee structure and more as this gets implemented. But secondarily, think about where you want the money to go and what you want it to do. Believe me, I have been thinking about this for a lot longer than just the last 7 months. That's how long I've known Whitney is pregnant. I've spent years thinking about how I could improve on what I did for my children, and what I did for my children was really good. I mean, I love the results, and my kids will tell you they felt blessed. Like literally their friends were envious of what they were able to do, and they have not spent up the money, which has been theirs for a long time now, but they have used it to help backstop their dreams and things that they were doing. I think that's just wonderful. So I had long planned on doing a stock portfolio, the same as I did for my children, but a lot easier to do now than it was 30 years ago. I also plan to do my own equivalent of a baby bond, but I want it to be for retirement rather than for when the child reaches the age of majority. That's what the stock portfolio is for, the ability to go, hey, you're 18 or you're 21, you've got this money, you can travel the world, you can go buy a car, you can use it extra on extending your education, you can use it as a down payment on a house, whatever it's going to be, you can take it. You've been massaging it and working with it because it's something that I would do with the child, and we go from there. So that's what I want the stock portfolio to do, is build that. But I want to make an investment that my grandson will really only touch when he's a little older than I am now. And for anyone who questions the value in that, go back and consider that double every 8 years thing that we were talking about. And realize that if you're talking about doing something for when someone gets 65, if you double 8 years, you get more than 8 doubles. So hang with me here. 1,000 turns to 2,000. That's one double. Then 4,000, then 8,000, then 16,000. That's 4 doubles. Then 32, 64, 128, and 356,000. That's, again, assuming 9%. But I'm hoping to do $2,000. So my hope is that my grandson will have the stock portfolio built for him and then come into an extra $500,000 or more as he nears retirement. And just think about where you are in your life right now. Even if you're comfortable as you prep for retirement, which, for example, I am as a 63-year-old man. Think about how coming into $500,000 or more at that point in your life could change your life, your family's life, what you can do for future generations, and more. That's what I'm trying to do and what I wish we were doing as a country. Now, I told Whitney that she and Greg should plan on the 529 plan for college savings. That's their thing. They're going to focus on the college stuff. I'm not. They should be watching to see how the birthright account grows. They're going to claim it. If they have anybody else who wants to contribute to it, that's fine. And if they get to where they max out contributions on the 529 plan, on any IRAs, if the child is eligible, and I will simply point out that I'm going to try to make the child eligible for an IRA. And I'll just note that that's not my grandchild. And once I have a grandchild, I will have sounders of my grandchild. And possibly I will pay for the child contributing sounders to the show. But that's, again, for another time. If you can max out your other contributions, that'd be a great problem to have. But for right now, and probably for the entire time that my grandson can have it, the $1,000 is a bonus. It's an account that they should let grow. and it will be a small tool in their toolbox. They are lucky that way. They have good jobs, they earn good money, they're going to be able to save, and they have good support. But for a lot of families, this will be a big tool, and I am all in favor of it, even if I recommend that families with the means use those means to save in better accounts. Look, anything that helps Americans save money, build up for the big things, and get to where they will have fewer problems in the future that helps to ease those burdens, I am in favor of it. And this is not a bad plan. I may not love the execution of it. I think at some point they may find ways to streamline it more and make it more like some sort of a special form of IRA. They may have to do that when we have a different president who doesn't want his name on the account there, and they just kind of call it, this is the birthright IRA or the Investing in America IRA that you get. You don't have that yet, but this is a positive. So take advantage of it if you're eligible. Get the account. I hope that America can commit to something like this in the future for everybody. That would be awesome. But I hope they also get to where they look for it longer term. So don't let this stand in the way of your longer term planning. And if you're like me and you're having grandkids, well, if you're going to support them more and do things to help them with their finances, know that this by itself does not remove that responsibility. It's just going to be something that helps and supports what you are doing on your own. There you have it. I hope you enjoyed it. I think it was pretty thorough and comprehensive there, but hopefully you now understand what it is. And if you have families that are expanding, go and get it. Yeah, you know anybody who's born this year, make sure they don't miss out. That's important too. Write me, chuck@moneylifeshow.com. If you've got questions, I'd love to get them. Up next, talking about amusement parks, and then it'll be time for the big interview. Stick around. This is Money Life. Now let's take a look at what the survey said. Yes, this is the Survey Said on Money Life. It's where we look at surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today it's not so much a poll, it's really a Google reviews analysis that may help you if you're planning to spend any time this summer at a theme park, because we are looking at work that was done for SudokuBliss.com by North Star Inbound, taking a look at America's top 100 theme parks to see where people complain about lines the most, and also where you might get the best return on your dollar with the shortest lines. If you want to learn more about it, find my guest, Melissa Stevenson, on the Money Life Show recent and upcoming guest page, or where we mention her in our show notes, and there is a direct link there to the study. But Melissa Stevenson is an analyst at North Star Inbound. She did the work for Sudoku Bliss. Melissa, thanks so much for returning to Money Life.
Thanks for having me again. Happy to be here.
This is a really interesting one because, of course, we know that what everyone dislikes about theme parks, aside from the cost, is the line. In this case, you're looking for who gets the most bang for their buck when it comes to shortest lines. You know, you could shorten lines by having a bad theme park, couldn't you? So are we sure that short lines are always good?
That is a great point. You know, places where people don't want to go, obviously, will definitely lead towards those shorter lines. I will say that some places really just do a good job at, you know, the foot flow of the park and getting people through. You know, you can't control the length of a ride, though. If it's a great ride and it's really taking you through an experience, yeah, it's going to take a little bit longer in a line.
Well,
and, you know, I do think that's why some people just wade through them and just complain about it later.
yeah, I think, but I also think, and the reason that I asked the question that way was something that was really fascinating to me in the research, which was water parks made up 6 of the top 10 theme parks that had the longest lines, but they also made up 5 of the 20 theme parks with the shortest lines. And you can understand why a water park's lines are longer. You can't necessarily do it like you do with a roller coaster where here's 20 or 30 people getting on at a time. etc. You have all of the potential delays where somebody gets up there and is scared, but nobody else can go around them because you're the next one in the tube or whatever it might be that you're doing. So you can see a number of reasons. But is that it? Or is it just that water parks, hey, it's a hot day, that's where everyone goes, so their lines are long because the weather is bad and they're the only game in town? Like, why do we have that discrepancy? Water parks good, water parks bad.
Yeah, I think what you said is right. It really just depends on the crowd there for the day, and also maybe some of the slides having a little bit quicker turnaround. If you're in the kids section more of the park and it's one of those water parks with a huge kids section, that's probably going to take a little bit longer because it takes kids a while to recover at the end of that, slide and get told, okay, we're ready to go next. And I do think the heat has something to do with it. Like you said, if it's a really hot day and this is the best place to cool off, everyone's going to be there. In addition to that, I think that it also depends just kind of on the crowds there. If like you said, a kid's scared, if there's some issues with other, of course, if something's closed, then everyone's going to the other slides. There's a lot of factors in there, like you mentioned.
Well, let's start with the places where maybe we can cross them off our list, or at least make sure that we want to get there at the right time of year or something. What are the theme parks that have the worst waiting times, and how bad are we talking about in terms of waiting times?
So we did have they were kind of spread out a little bit. We had Hurricane Harbor Park in Phoenix, technically in Glendale, Arizona there, and then Six Flags Whitewater in Georgia. So we had kind of, the way we broke it down was the percentage of people who said that they were waiting in the long lines, not necessarily the exact time, as that would be kind of hard to narrow down. But we did have almost 33.4% of reviews for the Hurricane Harbor Phoenix were saying, okay, we are waiting in consistent long lines. And then kind of a big drop off there for number 2, Six Flags Whitewater in Georgia, was about 16% of the reviews saying people are waiting. So I would say the Arizona park there definitely took number 1 by a large margin.
Well, and it was interesting to me that Six Flags had 4 of the 10 biggest offenders in terms of lines.
Yes, it did. I'm not sure if that is a management issue there or just kind of what the rides have to offer, but that's definitely a red flag seeing so many in the top 10.
Well, so now let's flip this around and help us figure out where we might want to take a sojourn to on our summer vacations. And there is one Six Flags park, I will defend them here, that makes the top 10, but the ones that visitors most consider worth the wait.
Yeah, worth the wait was also interesting because, like you said, people are still saying, okay, we are still waiting in lines, but these are people who still rated the park a 4.5 star or above. So that's showing us, okay, yes, they said there's some lines, but they still rated the park very well and enjoyed their experience. So, that's a great thing to note while you can't avoid lines at many places. So the worst the wait was the Land of Oz in North Carolina, and then Hershey Park in Hershey, Pennsylvania, which I have personally been to Hershey Park in Pennsylvania and loved it as a kid. So I can at least say I've been to one.
I have been to Hershey Park as well. I will point out, not only have I been to Hershey Park, but of the list of the top 10, I have actually been to 4 of the top 10. So I would say that they were worth the wait. The better news is that I've been to none of the bottom 10. So, and I would say now, not that I necessarily do a lot when it comes to theme parks at this point in my life, but with a grandchild on the way, they may be back in my life again in the future. I would say that, it's a good thing to know that if it's not worth the wait, it's probably also not worth the money. Like, I have to imagine that if we said, hey, what are the ones where people complained as well about higher costs and everything else? Once you've waited in those lines, you get grumpy about everything, don't you?
Absolutely. Yes. And that's when each dollar spent becomes a little bit more dramatic.
Melissa, great stuff. Thank you so much for joining me on the show to talk about it. We will talk to you again, I'm sure, about something down the line.
Yes. Thank you so much. Have a good one.
That's Melissa Stevenson. She's an analyst at North Star Inbound, which did this research for SudokuBliss.com. There's a direct link to SudokuBliss.com and the theme park lines work that she did if you find her on our guest page or mentioned in our show notes. And if you want big amusement and not much wait, stick around. Money Life will be right back, I promise. You won't be waiting in line for it.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
Welcome to the other interview on this edition of Money Life. Joining me now, Ben Cook. He's portfolio manager for the Hennessy Energy Transition Fund. That's HNRGX, if you want to look it up and follow along at home. Also manages Hennessy Midstream. That's HMSFX. You can learn more about him and the funds and the firm by going to HennessyFunds.com. Ben Cook, welcome back to Money Life.
Thanks very much, Chuck. It's great to be with you.
Let's talk about where we are right now with regard to energy policy, because, of course, we just had the passage of the big, beautiful bill. It rolled back some things that would have been good for alternative energy sources and the rest. So just give us a take on where the industry stands right now and how you see it progressing from here.
Yeah, sure. So from a policy standpoint, there's unquestionably a view at the White House that the Trump administration would like to promote the use of hydrocarbons as opposed to renewables, obviously, in contrast to the Biden administration. With the passage of the big, beautiful bill, we saw some maybe less punitive measures than anticipated on some of the renewable technologies, but there's no question we've heard from not only President Trump himself, but Secretary of Energy Wright as well, that they'd like to see coal, natural gas, and nuclear make up a growing part of our future energy supply mix.
In terms of what that does for energy, the big problem that so many investors have right now has been so much headline risk and so much uncertainty. Given what you've heard, et cetera, people like to look for energy for stability and the rest. Do we feel that energy can continue to provide that for their portfolios?
Well, we think it can. If you look over the near term, we anticipate that crude oil prices will remain subdued on the back of adequate supplies. As you may know, OPEC Plus and their quota alliance will be returning a little over 2 million barrels per day by the end of September of this year. That should provide for oil price stability, we think, through the end of the year. And we are amply supplied on the natural gas side for the moment. We think that natural gas prices will remain in the $3.50 to $4 level. Those prices are generally acceptable to the broader market, to the economy, and ultimately they're beneficial for producers as well. They'll continue to generate good returns in the form of dividends and share repurchases. We think it's a good commodity environment for both producer and consumer.
Is the benefit right now to the toll takers or the producers? And obviously you run the Energy Transition Fund, but also the Midstream Fund. The Midstream Fund, that's typically the toll takers.
Yeah, on the midstream side of the business, we do continue to see favorable market conditions. We believe there's going to be a growing appetite for U.S. energy, continued growth in U.S. Crude oil exports and refined product exports. Obviously, the growth in LNG export volumes has been well documented. We'll likely double our LNG export capacity over the next 4 to 5 years. And that all means increased usage of energy infrastructure. So for those companies operating pipelines and charging tolls on volumes that are transported and stored and ultimately exported, the midstream sector stands to benefit quite handsomely. And that's an area of focus for both of our funds here going forward into year end.
As we look at what's been going on with energy, it's not a direct AI story in terms of, what's been driving the market has been AI. And at the same time, what we are hearing about repeatedly is how much energy AI requires, how much data centers require, all those other sorts of things. How is that development impacting energy, and will it continue to impact energy? I mean, if AI is the next industrial revolution, what has historically happened to the energy business as it supports industrial revolutions?
Yeah, there's no doubt. We think it's going to be a major tailwind to demand growth for those fuels that will make up the energy source for power generation that will be necessary to supply this AI boom. We look at it from the perspective of the natural gas value chain, as we see natural gas as a logical solution to the fuel needs in terms of generating power for the AI boom. If we look towards the end of the decade, and these are data points we're hearing from the utility sector, the producers of electric power, we see an additional 8 BCF a day of natural gas demand coming from electric power load growth through the end of the decade. So 8 BCF a day roughly means about 6 or 7% of the current supply base of U.S. production of natural gas. So, an incremental growth in natural gas usage will necessitate the growth in supply needs. We think we'll see the price signals and the volume growth that will benefit the entire natural gas value chain. The producers will benefit from rising volume growth and firmer prices, and the midstream companies should benefit from the transportation, storage, and ultimately distribution of that natural gas to generate power to fuel that AI boom in what you termed almost like an industrial revolution.
With all of that and the focus in that area, the story that seems to be missed is that the U.S. is the number one producer of oil at this point. How is that side of the energy business impacted? And do we need clarity on the final outcome of tariffs to really know what's going to happen next?
Well, we do, in terms of tariffs, we do know there will be some impact to global demand for oil as the tariff impact slows global economic conditions. Just as a matter of data points here, economists are forecasting a decline in global GDP year over year, 2025 versus 2024. And part of that is due to the impact of tariffs. Global demand for oil will rise, or is expected to rise in the order of 1 million barrels a day this year, which would be a slight decrease from the growth rate last year. But if you think longer term about the impact of the supply that the U.S. has been able to deliver to the global market, it's been a rising percentage of the supply mix. But it's important to point out that with what we're seeing in terms of OPEC's return of volume to the market, OPEC is pursuing a larger percent or market share of the global market, and that likely will present some headwinds to pricing. And we're also already seeing some contraction in the U.S. industry. We're seeing lower rig counts on a year-over-year basis, and we're seeing lower frac fleet counts as well. And that portends for a stalling in U.S. production and potentially a decline in U.S. production next year. We will continue to remain a leader in oil production to the global market, but there's no question OPEC is seeking to regain their status as a market share leader in the global space.
The other trade deal that, of course, impacts energy tremendously can be Canada. That one still seems to be hanging on for a while with outcome there. Is that going to wind up having a bigger impact? Because the truth is, tariffs has been a great story to talk about, but they've had less impact than I think most people have expected on most markets, even as they've lingered around for a while waiting for some clarity.
Yeah, the supply of Canadian crude to the U.S. is significant, and it is an important feedstock into the U.S. refining business, particularly in the Midwest. The reality is that while the Trump administration would like to articulate the ability of the United States to act independently without Canadian crude volumes, the interconnection and the linkage between supplies there and our midstream and refining space here in the U.S. means that it would be a significant challenge and undertaking for our industry to try to reconfigure itself to access supplies to displace those volumes that come from Canada. I think that we'll continue to maintain our interdependence on Canadian supplies for some time, even with the impact of tariffs.
Let's discuss a name or two that for you are exemplars for the industry right now, the kinds of things that you particularly like, because you've talked about where the potential is, but I know that you normally, do cut it down to brass tacks.
We do, as part of our repeatable investment process in managing the Hennessy Energy Transition Fund. We do look for companies that possess good asset bases that generally have a low cost structure. We're looking for balance sheets that have a visible path towards improvement. And then, of course, management teams that have demonstrated the ability to execute both in good times and bad. And at the moment, where we're seeing opportunity is along the natural gas value chain. We talked about the AI demand trend. The build out of LNG export capacity is also an important tailwind to demand that will unfold over the next several years. And to participate in that trend, we see opportunity in both the upstream and the midstream. We like a company called Expand Energy. Expand was formed last year through the merger of Chesapeake Energy and Southwestern Energy. They are the nation's largest producer of natural gas. They've been adept at reducing their debt level over the last 4 quarters, and that's allowing them to redeploy capital to grow their business. And we see them growing into a higher price environment this year and next. And importantly, the company will be repaying debt in 2025 and also buying back shares as well as paying a variable dividend. So again, the capital discipline and the return of shareholder theme here is very strong with Expand. Valuation screens are relatively attractive to its peers, and we see that as a preferred way to play the natural gas theme. I'd also say that Williams Companies is another beneficiary of the growth in the U.S. natural gas market. They have premier assets across the country that are replicable. The company is growing rapidly, more so than its peers. That growth will translate to improved dividend payout and, again, shareholder return. And interestingly, the company is not just benefiting from growth in its midstream business, but they are participating in the AI power boom. They have a project in Ohio that will generate electricity for hyperscaler Meta, which will occur in 2026. So they are participating in the AI boom, and we see them as a natural beneficiary there. Again, valuation screens attractively, and again, we see it as a preferred way to play the AI boom and the broader growth in the natural gas business here in the U.S.
Ben, great stuff. Really interesting catching up. I look forward to doing it with you again down the line, but thanks so much for taking the time to join me on Money Life today.
You bet, Chuck. Always a pleasure to be with you. Thanks very much.
That's Ben Cook. He's portfolio manager for the Hennessy Energy Transition Fund. That's HNRGX. Also, Hennessy Midstream Fund. That is HMSFX. You can learn more about the firm and the funds by going to HennessyFunds.com. We've got more to go on today's edition of Money Life, so settle back and relax because we'll take a quick break. Be right back with more financial talk in just a moment. This is Money Life. We're back to wrap this one up. And, you know, if you listened to the end of yesterday's show, you were expecting John Sylvia to be here. He will be, just obviously not today. This one was completely my fault. There had been a change that he had requested in taping times, and I granted the change, but I also kept it in where it had been, and therefore I had it on the schedule to be taping, and I messed it up. So that's fine. It gave me the chance to answer the question, which I was really happy to be able to do. So tomorrow on this show, Vincent Randazzo, Chief Market Strategist at ViewRight Advisors, brings a really interesting style to talking technicals, and Garvin J. Bush, Chief Investment Officer at Green Alpha Advisors, returns to the market call. All that and more, so lock us in and plan to be here tomorrow. If you're looking for something to celebrate today, it is National Kitten Day. That doesn't sound like a kitten, but still, you get the point. It is National Clerihew Day. A clerihew is a poem, a style of poem created by Edmund Clerihew Bentley in 1891. He was 16 at the time. A clerihew is supposed to have 5 things. It is supposed to be 4 lines long with rhyming couplets of AA and BB. It's supposed to have a person's name in the first line, something then said about that person through the other lines, and humor, because clerihews are meant to be funny. Frankly, I could give you examples, but I probably couldn't find any that I thought were genuinely funny. Yeah, I'd rather have a limerick if I was going to do that, or whatever. I don't really. They try. I've seen them. I've tried to write them. Yeah, pretty tough to do. On the food front, well, this one's not actually food for us, but it's Teddy Bear Picnic Day.
I'm smarter than the average bear.
That would be an actual bear picnic, I think, it's Pick Blueberries Day, and then it's National Pina Colada Day.
To alcohol, the cause of and solution to all of life's problems.
And I can't believe I don't have the Pina Colada song for you on that one. My guests today were Todd Rosenbluth, head of research at Vetify, online at vetify.com. Melissa Stevenson, analyst at North Star Inbound, which was doing the study on theme parks for SudokuBliss.com. And Ben Cook, portfolio manager for the Hennessy Energy Transition and Hennessy Midstream Funds, online at HennessyFunds.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly, thanks to you for being here, because you make this special one with Wild for me each and every day. The Money Life quote of the day comes from Aswath Damodaran, who said, investing is about preserving and growing wealth. It's not about getting rich. He's not wrong about that. I mean, you'd love to be able to get rich, but if you can preserve and grow your wealth, you will come out at the right place, which is why you've got to keep things in perspective. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Okay, time's up. Now get out.